You can save 15 to 20 minutes of your time when boarding a flight from Delhi Airport. Delhi Airport has for the first time in India introduced a self-dropping facility for baggage at T3. This facility allows passengers to check in their own baggage without the help of airport staff and importantly without standing in long check-in lines. For travellers, a self-baggage drop facility involves a two-step process. First, passengers can generate their boarding passes and baggage tags at the self-check-in kiosk. Then, after tagging their check-in baggage, passengers can load their baggage onto the designated belt. Currently, passengers travelling in Indigo can use the facility. 5 other airlines, including Air India, Vistara, Air France, KLM and British Airways, are expected to allow usage of self-baggage drop for their passengers soon. Equity markets settled with mixed results in a highly volatile trading session. Losses in state-owned lenders and energy stocks countered gains in consumer and pharma shares. The Sensex closed just a touch below 63,000 and the Nifty was just a touch higher. Top gainers today Cipla, Adani Enterprise, Hero MotoCorp, Tata Consumer and UPL. On the downside, Reliance, TCS, NTPC and Coal India. Let's take a look at what else is making news on the Lal Street. ICICI Securities jumped as much as 15% in trade today to hit a 52-week high. The company had unveiled plans to delist from the stock exchange, likely by swapping its shares with those of parent ICICI Bank. The board will meet this Thursday to formalize the plan. ICICI Securities shares ended up 10.5% today. Shares of Shree Cement tanked over 10% on reports of an alleged evasion of 23,000 crore rupees in taxes. According to the report, the tax evasion was found during searches at the company offices in Rajasthan. Reports say the survey at Shree Cement offices is still on. The company, which is the third largest cement manufacturer in India, has refuted the evasion reports. All Adani Group stocks ended in the green, stock prices jumping by 0.7 to 5%, coming after Gautam Adani-led conglomerate said it was eyeing 90,000 crore rupees in EBITDA in the next 2 to 3 years. This would be a significant boost from the group's current EBITDA of around 50,000 crore rupees. The ports to energy conglomerate is expecting strong growth in sectors such as airports, cement, renewables, solar panels, transportation and logistics, as well as power and transmission. With equity markets entering a volatile phase, Udayan Mukherjee, India Today Group's global business editor, spoke to market guru Sankara Narain, ED and CIO at ICICI Prudential AMC. Here's an excerpt.
Despite the recent rally, returns have been sort of lukewarm for Indian equity investors, 10-11% kind of return over a 2-year period, which is a bit subpar. So are you confident that the next couple of years will make up for what has been a fairly pedestrian run for the last 24 months?
And actually, the returns that you've seen in Indian equity markets and in Indian small cap and mid caps have been about one of the best in the world at this point of time in the last 24 months. So while it may appear that the returns have been modest, I would say it is one of the best returns that you've got anywhere in the world. If you look at the future, I would say that, we are in a very structurally in a very good shape. And that geopolitically we are in a very good shape. And from a macroeconomic point of view also, we are in a very good shape. And having said that, the challenge is that from a valuation perspective, we are one of the costliest markets in the world, and outside US, I would say we are one of the costliest markets at this point of time. So even going forward, it's tough to believe that you can get very big returns in the long run, in the medium run, I mean. But it is still India is one of the best markets to invest in for the long run. And because it's a very good structural story. But if the valuations were to become more reasonable, I think India would be a great market where you can get both good long-term returns and big long-term returns. Whereas today, because of valuation, it's difficult to predict very high returns at this point.